Current trends in consumer credit show some improvements among higher and middle income households, while lower income Americans are seeing delinquencies rise. That's according to the latest VantageScore data. Joining me now on this, we've got Rikard Bandebo, VantageScore Chief Economist. Rikard, always great to see you. So overall credit landscape, let's break it down by cohort, Rikard, at first. Start with the higher income households. Sounds like some improvement there in delinquencies. Why is that, Rikard? Is that income growth, it's rate cuts? What do you chalk that up to?
I think, first of all, it's a very good sign because we've been seeing since 2023 to the first half of this year that actually the higher income households, which are households with 150,000 earnings and above, had actually been seeing the highest relative increases. But since July, we've been seeing them not just stabilize, but also come down 3 of the past 5 months. And because they are responsible for so much spending, they have a huge impact on the economy. So seeing the fact that they are seeing their delinquency rates coming down should be a good sign for how the economy may be faring. So the reason that we are seeing improvements there is probably due to the fact that they have been able to see better income increases than other cohorts, and also they're perhaps being able to tap into other sources of equity, such as their home equity and other lines of credit, to be able to make sure that they're doing well.
All right, that's higher income. What are you seeing, Rikard, with middle income, lower income?
So middle income has come down. So in terms of it's still increasing, but the relative rate of the increase in the middle income is lower than it was in the first half of the year, which is a good sign. So they're seeing around about 3 to 5% year-over-year increases. But lower income is staying persistently higher at about 7 to 8, 9%. So they're now. So it used to be that for the past couple of years, lower income we're seeing less increases in the other 2 cohorts on a relative basis. But now lower income is remaining at that kind of 7, 8%.
Well, how do you explain
whereas
that,
the others
Rikard?
have come down? So lower income households are, they don't have necessarily the same means. They don't have as many assets that they can, tap into when they're struggling with a monthly payment. So if they're suddenly hit with an unusual bill of some kind, they're the ones who will have the biggest challenge trying to handle that bill when that happens.
So that's breaking it down by income cohort. Do you also, in the data, Rikard, do you have line of sight as sort of generational differences?
Yeah, we've been seeing quite a few movements in the generational side. Obviously, what you'd expect is that, for instance, Gen Z has been is seeing some of the highest delinquency rates amongst the different generational groups. However, that's been coming down. So it does seem like Gen Z has been able to adapt to the more challenging income environment that they're facing by living at home or just being much more careful with their spending. But reality is they've also been quite impacted by student loans, as have some other generations, and we're seeing that a lot of those households and consumers that are impacted by student loans have definitely also then reacted to those student loans by reducing their spending in other areas.
In terms of loan type, Rikard, what are some trends and themes that we should keep our eye on? Credit cards, personal loans, autos.
Yeah, so I mean, overall, we're seeing that consumer credit health is pretty stable, although we are expecting more households to struggle to make ends meet next year. As we look at, though, delinquency rates across different products, we're actually seeing that many of them are at their highest or near their highest they've been since just after the last financial crisis. So if you look at things like auto loans, they're definitely higher than they've ever been before. We're seeing student loans, since they resumed, are incredibly high. They're about double the average that they used to be before the pandemic. And then we're also seeing quite high rates in credit cards and personal loans. However, we are seeing that delinquency rates in mortgage and housing-related debt are still at a much lower level than they were in the 2010s.
Looking ahead, 2026, you expect delinquencies required to rise modestly. Why do you expect that rise there? I mean, is that weaker job growth, Rikard? Is that dwindling savings? What's going to be the driver?
I mean, we've continued to see this trend for the last several years, honestly, since about 21, right? And so we're not seeing anything in the economy that's going to take it the other direction. But we are seeing it stabilize, which I think is the good thing here. And the reason for that is, at the end of the day, households are dealing with a bit of a price shock they're still recovering from 22, 23. And so that's put pressure on their outlays. At the same time, The job market isn't as strong as it was. So there are definitely more households being impacted by both of those factors.
These delinquency trends and trajectories we're talking about, Rikard, how sensitive are they to the Fed's rate cut path next year?
So we do think that it should help, particularly for instances like mortgage. Mortgage affordability is obviously one of the things that's most talked about. It's the biggest outlay that many households have. Auto loans, obviously, it'll have an impact as well. But you've got to remember, with auto loans, when you buy your car, you signed up for that loan for a number of years. So most people don't tend to refinance those as much. But with mortgage, you may soon get to the point where it actually makes economic sense for many households to go and refinance. But also next year, there's a really good opportunity in housing in terms of being able to open up a lot more housing to first-time owners, which will be interesting to see how that goes.
Rikard, always great to see you, especially on set. Thank you, sir.
Thank you.